Hey, well, welcome everybody to Education and Events 2024. My name is Jeremy Davidson. I'm the chair of the committee for this year and really delighted to have some wonderful guests with us today. And from what I've heard, a great number of people who are joining us. So thank you for taking some time out of your busy week. So today we're going to be looking at what buyers and sellers need to know about insurance. We all know that insurance right now is a very hot topic, but it's always an important topic regardless of what's happening in the news and on the ground. It's something that we always should pay attention to. So we're really glad to bring you an update. We have Alie Lopez from ProCo. God, that's a mouthful. ProCo Global. Alie is a licensed insurance agent. She's from Marin. She's been working with buyers and sellers for 10 years. And then we also have Aaron Thach from Farmers. Aaron's been in insurance for 16 years. He's been with Farmers for half of that time, and he does a lot of work with residential properties. And we're going to have our very familiar MrDantastic, Dan Hershkowitz, who is the senior director of risk management at the agency. He will be moderating today and sharing his expertise as well. And just so everybody knows, the webinar is being recorded and it will be posted on the SFAR video library for your viewing enjoyment and to pass on to people you know. So with that, if you do have questions, I believe you can type them into the Q&A. We will make sure that there's time at the end for that. So without further ado, I will pass the baton over to Dan.
Fantastic. Thank you so much, Jeremy. Excited to be here. And also to Nicole K. Thank you very much, Nicole. Many of you know Nicole from Citi, and she is kicking butt over there. And she has a great history that started out in title and escrow. And so some of you may know her from that. And a vast wealth of knowledge, and we're thrilled to have her here today as well. All right, people, we're going to learn lots today. The first thing we're going to learn is that Alie went to Novato High. She is a local, go Hornets, and her favorite ice cream is Rocky Road. I'm not sure if we can trust her or not. Aaron Thach, he is also a local, extra local. He went to Wallenberg High, go Bulldogs. And that's what he says. He is a bulldog out there fighting for you. His favorite ice cream, a much more reasonable choice, mint chocolate chip. All right, let's see what these slides say. Let's start our learning. So I have here, oh, that's so funny. I pulled up the wrong set of slides. So I will look at the computer in front of me. So where do we start? If you could scroll down a little bit, Jeremy, or hit our first slide. Great. So I put out some resources for you here. And so what we're seeing, Jeremy, the view that I'm seeing is multiple slides. I don't know if we have an option to click on one at a time and make them a little bigger. Fantastic. Worked perfectly. So I wanted to make sure that you had some resources as well. So in the first two slides, we have some insurance resources for you. And so we are now scrolling continuously. If we could go back a few. Seems to be on an auto thing. I'm glad we're making Jeremy do it. So that you know, we have a couple of resource slides for you. That one said continuous scroll. I'm curious. I think that's the one that goes automatically. Single page? Well, we'll do that for a while. That's fine. I'll lean in. I can see it. No worries. We know the materials. Ah, there we go. Wonderful. Okay. So last year, you may recall, didn't the governor do something? Well, here's what the governor did last year. The governor put out an executive order and ordered the insurance commissioner to do some things. They are actually working together. The insurance commissioner, the California Association of Realtors, the National Association of Realtors, all of the lobbyists, et cetera, understand that you are under an insurance crisis. And I think in some ways it really feels like a crisis. And we're not going to downplay that at all. Here is a brief summary of what this insurance reform of 2023 was supposed to do and is supposed to do. Among some of the things it's doing is it's putting pressure on the insurance companies who are trying to leave. It is adding resources to the FAIR plan, which is an alternative we're going to talk about. One of the problems with the FAIR plan is its low insurance thresholds, which have been increased substantially. Whether or not this is working on keeping the insurance companies in the market is an interesting question, and I'm very curious what our experts are going to have to say. Let's move on to the next. And so one of the things that we'll also see is the idea, and this one certainly resonates with a lot of people, and it's a kill two birds with one stone concept, is, hey, if I do some work to make my house safer, shouldn't that translate not only into a lower risk, but then into a lower premium? And so we have the Safer from Wildfires mandated discount concept. It is happening with the FAIR plan. I'm very curious to see what our agents have to say, our experts have to say, whether or not the individual companies are also going to be giving discounts. And the idea here is that we do fire hardening, right? And so remember the concepts of fire hardening and defensible space. All right. And then so let's start here, right? So we have insurance agents and insurance brokers, right? So we're used to the concept of an agent versus a broker, but we're used to it in a little bit of a different context. And I'd love to jump in right now. Here's our time to talk to our experts. I think one of you is an insurance agent working for one company, Farmers, and one of you is an insurance broker working across the field. So let's start with Aaron. Aaron, tell me, which are you, and tell me how it works.
Yeah, I'm actually an insurance agent with Farmers Insurance. I'm a captive agent, which means I have to put all my efforts towards Farmers first. Fortunately, Farmers also has a brokerage that they own, Craft Lake, that they allow us to have access to other carriers whenever Farmers doesn't have an appetite for that risk. Other carriers like State Farm and like AAA, they can only sell AAA and State Farm. They cannot go outside. So I'm a little bit fortunate. I'm kind of like a hybrid between a captive, agent and, an agent and a broker.
Thank you. I appreciate that. So not to be suspicious, but this is important for a real estate agent to understand, right? And for the client to understand. So when you're making a referral, right, one of the questions might be, if they don't have what you need or want, the question might be to ask the second question, which is, hey, is this available somewhere else, but you're just telling me your company doesn't offer this, right? Let's not presume this type of coverage isn't available. It may just be that this agent doesn't have it to sell, and you have to go to another store in the mall, so to speak. Okay. Alie, what about you?
So I'm a broker. And our main responsibility is that we have a fiduciary responsibility to the client, and we're more of an advocate for the client versus the carriers. And we have access to carriers not just within the state, but nationally. So we're not captive to just this location.
How does it work in terms of your relationships? I would think that you are being bombarded by carriers or others who want you to be selling their products and suggesting their products. We as real estate agents have RESPA, for instance, which tells us when we can take referral fees and things so that we're not putting extra costs on top of the consumer, right? So what are your restraints, and how do you go about trying to figure out who you're going to refer the agent, the client, the buyer, for instance?
Well, so we don't charge a broker fee. The way that we're compensated is a commission from the company. As far as how do we place clients with that certain company, we just have an understanding of the company's appetite. So each company kind of specializes on a type of property or a type of risk, and then we go from there.
Great. And I think we'll see more about that in a little while. All right. What about barriers to obtaining new policies? So this is one of the things that I think is really what the agents want to hear. All right. So agents, we're hearing you. I saw your emails, your questions. And so much of it comes down to this page, frankly. So some of the things that I've learned, and I want to give a little summation, and then we'll go to each of you. What I learned over the years is, and teaching a few of these classes, is the prior claims history is really interesting. We used to think, when we had that clue report, which is now much harder to get, unfortunately, that the history of the property was really the big thing. But it turns out it's really the history of the buyer and the claims made by the buyer. And although the history of the property is important, what the insurance companies are typically looking for when it comes to the history of the property is, have the repairs been made that were necessitated by that claim's history? So for instance, there was a prior electrical fire. Was the electrical system upgraded? Were there permits that were pulled to do all of the repairs? Was there remediation of potential asbestos and other hazardous materials that were set on fire, right? That's important for them to understand. But when they're talking about rates, interestingly, apparently their actuarial tables, their their logarithms tell them that if the buyer made claims previously on their previous home or homes or auto or whatever policies, the buyer is more likely to make claims here, and the buyer's insurance is more expensive. And where this becomes frustrating for a real estate agent, especially in this market, is you want to get all of your ducks in a row when you have a listing. And so what you want to call Alie or you want to call Aaron and say, hey, I have a listing coming up. It's a single family home in Bernal, and here's its dimensions and blah, blah, blah. Can you put together a rate sheet so that the prospective buyers know what they're going to pay? And the answer is not really. I need the name of a buyer. All right, so Alie, why don't you tell us if I was right and how this is playing itself out, and then we'll hear from Aaron.
Yeah, no, you're completely right. When it comes to the property, and we do run clue reports ahead of time, we just want confirmation, or the carriers just want confirmation that everything's been repaired and that there are no current open claims, that if there is a claim, that it's closed, because an insurance company is not going to offer new coverage when there's an active open claim. And you're correct that the buyer is really who gets dinged on any future policies with past claims.
Let me ask you a question, and Aaron, feel free to jump in about the open claim concept. So let's say that there was, in fact, a claim. We have a small electrical fire. It was now a year ago. It took 5 months for them to get permits. It took another 5 months for the repairs to be done. The former seller is still waiting on the final inspection. The contract says something about the final inspection, and that if it goes past close of escrow, they're going to hold money back, blah, blah, blah. But the original owner, the seller now, is also fighting with the insurance company over what is covered and what isn't, and how big the check might be. Is that an open claim that is going to prevent the close, despite this desire between the owners to have this holdback?
Yes, that definitely will. That's still considered an open claim. Typically, the carriers are going to want you to close the claim. Tell the seller, hey, tell them to close the claim. Otherwise, a lot of carriers are going to say, hey, we're just going to wait until it's closed before we want to take this on as a risk.
And does it matter whether it's the same insurance carrier or another one? That's sort of an interesting question. If you're a buyer buying a property, is it more or less, or totally does not matter if you're trying to get a policy with the same company that has been insuring that exact same property for the last 25 years?
Doesn't matter. It doesn't matter. And if anything, it's when there's a transaction, it's a way for the carrier to now be off of that property, especially if they have already paid out a claim or are in the process of paying out a claim.
Aaron, your experience, same thing?
Same thing.
Isn't that frustrating? So someone is thinking to themselves logically, wait a minute, you've been insuring this for 25 years and you were perfectly fine with it. And now I try to simply go into year 26, and the answer is no. Frustrating. All right, let's go on to the next item on our, nope, if we could go back, Jeremy, we're working through that slide. Thank you. Hazard zones, fire, flood, quake. So one of the things that I have also learned here is that we're used to the NHD report, right? Which shows us, are we in a high or very high fire hazard zone and ordnance zone and all these zones, right? And we think about fire, flood, and earthquake zones. What I have learned is these government maps are not necessarily the maps that the insurance companies use, and that most of them have their own insurance carrier maps. And in a little while, we'll understand that even beyond the maps, they're interested in the address, not just the area. And beyond that, even if they were perfectly happy with one of the properties down the road, they may not be happy with this property, not because it's characteristically different, but because they're risk averse and they don't want to have too many eggs in one basket. And so if there is a fire that comes through, one of the concepts the insurance company says is, well, how many homes do we have insured that might burn? And so we'll do 2 on this street, but we won't do 3, and we won't do 4, 5, and 6. And although we don't sell subdivisions here in San Francisco, imagine if you were selling a new property in a subdivision and you had confidence that you would just put one of your other buyers with an insurance company, and you're shocked to find out, wait a minute, the property 3 doors down, which is the exact same property, they're not going to insure. Alie, tell us more about that.
Yeah, so that's what we call oversaturation, and a huge issue that we're coming up against. And it's frustrating because, especially as we run into non-renewals, understandably, a neighbor may go to, someone across the street and say, hey, who are you insured with? I'm being dropped. They'll give a name, but again, like just as you described, you hit the nail on the head of they may insure 5 on that street, but they won't do a 6.
And Aaron, you must be feeling this, right? You must hear this from your clients.
Actually, fortunately, with farmers, we don't have that rule. As long as they meet all the criteria, their home is insurable in good condition, no, eligibility with losses, we can, and they meet the fire line scores, we can insure them. But I do know that some carriers like, Bamboo, they'll say, hey, we hit capacity. Think of it like, buying stocks, right? You don't put all your money into one stock. You kind of spread your risk. And that's what the carriers typically want. With farmers, they are allowing it right now. So they don't really mind everything being concentrated. But if they feel like there is too much in one area, for example, like commercial risk, if we have too much commercial real estate in that specific category, they may say, hey, let's put a pause on it because we don't want to take on more exposure in that portion of the business. We want other portions of the business to be, spread out.
Well, I imagine, so first of all, that's very interesting. And I'm sure there are a lot of people who just took a pencil out and wrote down the word farmers, right? For that very reason. Good for you. But that actually raises the next question, which is, what if farmers has just made a decision that the category they're not so interested in is condominiums, right? Or single family homes in California? What are you seeing right now internally with your own company where they're interested, or more importantly, where they're disinterested in writing new policies or renewing policies?
Yeah, so in terms of renewing policies, we actually have never done this before. We started doing renewal underwriting for existing clients, meaning, hey, we're looking at every single home, aerial view and everything. And if it doesn't look good, we're going to let them know, hey, you need to fix your roof, you need to fix this or fix that. There's too many overhanging trees over your house. Like these are claims waiting to happen. So either you fix it or we're going to non-renew you. That's what we're doing right now. We have been overexposed in the renters market, the landlord market, and the condominium market. So we actually put a pause on writing all those businesses right now. The only thing we're still writing is single family homes. That's your primary residence in terms of farmers.
So that's really important. Let's just talk about that for a moment. So condos are having many, many challenges right now. One of the challenges that condos are having is the insurance that they already have, even if they already have insurance. And the challenge that they're finding is that the lenders are looking much more closely at their coverage and saying, no, 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 you're way undercovered, right? Building expenses, costs to rebuild, liability after the Florida collapse, et cetera, has put a spotlight on this. And we're finding a lot of condos are underinsured. And so a lender won't lend to them. And so then they go to their insurance carrier and they try to increase the coverage. And what we're just hearing from Aaron is really important to know. Many insurance companies are not interested, right, in increasing the coverage because they're not even interested in writing on condos anymore, right? And so they don't want to get farther down the line with a deeper, more extensive coverage. And so this is becoming a real challenge. There are a lot of underinsured condo complexes. And as a result, there are a lot of condos that can only transact if they are transacting for cash. And then the buyer is walking into a situation when there is a loss, they may not have the money to cover it. Alie, any thoughts on that?
Yeah, I mean, we're running into it a lot with HOA coverage, if that's what you're referring to with lenders. They're looking at the limits and just not having coverage. So a lot of these older Allstate, State Farm policies have not been updated, have not been re-inspected, have not caught up with what they should be, what the replacement cost should be, and they're being non-renewed because they're exceeding their capacity. So we're running into issues where we can maybe find walls in or HO6 coverage, but then you don't have a master policy. More than 50% of HOAs that have been non-renewed that have funneled through our firm have had to go with non-admitted companies. So like Lloyd's of London and Scottsdale's, because of characteristics and just being outdated.
Non-admitted meaning that they don't have the same regulations by the California Department of Insurance, and therefore there are some protections that a consumer would have that they don't with these companies. It's more of a contractual relationship, not a regulatory relationship.
Exactly.
Okay, so there's several things here. We're going to talk about renewals, I promise you, in a little while. HO6, just for a moment, and walls in are two things that Alie just said. That refers to not the master policy of a homeowners association, but the policy that the individual owner would carry. So imagine for a moment that the condominium complex has a fire and 10 units are affected. The master policy would be paying to rebuild. The HO6 or the walls in, the supplemental condo policy that the individual owner would have or maybe not have, right? Some lenders require it, others will let you take a loan without it. So it's up to the individual to have or not. And that's a conversation you'll be having with your buyer. That will cover the stuff from the walls in that was not part of the original construction, typically the floors, the cabinets, et cetera, and that can get very expensive. And also liability if someone comes in and slips and falls inside the house, sometimes medical related to that. And then where am I going to live during the construction? That's also part of the HO6. And so even if the HOA is underinsured, the individual should make sure that they're not underinsured and they have an HO6 policy. Just for reference, I have an HO6 policy. I live in a townhouse in San Francisco, a place called Lake Merced Hill, and I have an HO6 policy that includes a rider for earthquake, even though I don't have a master earthquake policy. Why? Because if there is an earthquake, which is what displaces me, yes, it's true that the HOA doesn't have a policy that will rebuild, but I now have 24 months of where am I going to live coverage through my HO6 while we figure out the rebuild based on that earthquake. Okay? All right. Physical characteristics of the property. If there's anything the agents wanted us to talk about today, and I'm sure that Jeremy and Nicole are saying, yes, please get to that. It's okay, what are they now requiring in anticipation of writing the policy? And when do they give us real underwriting? And so one of the things that we learn is we feel like we have this insurance policy all wrapped up for our clients. We've sent them there. They say, great, here's what your coverage is going to be. And here is the premium, and it will start at close of escrow. But the fine print is there's some underwriting. Sometimes that takes place before close of escrow. And believe it or not, sometimes that takes place after close of escrow. And so this is when we're learning about roof type, right? And then they say to you, okay, the roof is out of date. And you're like, wait a minute, it is? In San Francisco, one of the problems is not only do we have older roofs, but most roofs are done without permits. And so when you look at a 3-hour permit report, you're probably used to seeing someone taking out a roof permit, but it never got closed or finalized. That's the case in like 90% of the roof jobs in San Francisco. The roofer takes out the permit in case the city shows up while they're on the roof, but they never get it inspected and closed out. That is a norm here. The problem is, will the insurance company be happy with that? We throw that up in the air. Insurance companies are interested that the roof is not older than a certain period of time. We're going to hear about that in a minute, what the standards are. I'm hearing 15 years. The insurance company might be interested in the foundation type, and they might ask questions. They may be interested whether or not it's original heating, which comes with asbestos ductwork often. They may be interested whether or not it's knob and tube, and this is a effing nightmare lately. We're going to talk about that. Original plumbing, automatic shutoff valves, whether or not it has a pool. I know we don't see a lot of that here. So boom, there's our topic. Alie, talk to us.
Yes, this has been kind of the bane of our existence in insurance right now, mostly because the carriers are just very strict on what they're willing to cover because they have experienced so many losses. Especially first quarter of last year, the rains, the amount of leaks and water damage that was done, they're really reevaluating what they're going to cover. As far as our carriers, we've always been known to ask anything built pre-1945 if there has been knob and tube wiring. It is a clear no from the carriers. They will not offer that coverage. Just as a reminder, insurance doesn't cover maintenance issues, and knob and tube, an old roof, faulty plumbing, that could be considered a maintenance issue and then deemed not, or there may not be coverage for that. It's up to the discretion of the company if they determine it as a maintenance issue versus a catastrophic event.
Let's just stop there for a moment. So even if they do write a policy that includes a house with knob and tube, it's possible that when there is a fire, they say it was as a result of a maintenance issue and try to deny coverage. That is not nice. But what's worse there is you gave a deadline of 1945. Gee, do we have any houses in San Francisco that were built before 1985? I'm sorry, 45? Pardon me. Yeah, 60% of them. If it weren't for the sunset, it would probably be like 85% of them, right? So that's a big deal. So if you're a listing agent, one of your early questions with your seller is, let's get an inspection now, not just for a pre-sale, but so we understand what we're going to need to do here, right? And maybe some of our concierge dollars that we've been talking about spending on making the house pretty are spent on making the house saleable so that some buyer can actually get insurance and get a loan. And that may include knob and tube wiring and getting the home rewired. For unfortunate context, I lived in Diamond Heights, right? And Diamond Heights was built between 1940 and 1988, basically. I had a house that was built in the 70s, and it had knob and tube in the 70s. And so when I redid the house, we pulled out all of the knob and tube. One of the problems you may have is, was it really all done? And so be suspicious of a client who says, yeah, it was all done. And what proof are we going to need? That's another question for you guys. Aaron, your thoughts on roof type, foundation type, knob and tube wiring, etc.
Yeah, for roof type, we typically want it within the, newer, 15 years or newer. If you want replacement costs on the, on the roof. If you have an older roof, farmers will still take it, but we're going to give you actual cost value on the roof. So there is a difference between replacement cost and actual cost value. One is basically we're going to pay to replace your entire roof because of a covered loss, or the other one is we'll pay for your loss minus depreciation. So if you have a roof that's supposed to last you 30 years and you've had it for 20 years, you're only going to get, whatever that 10 years left is on minus depreciation. In terms of
what about proof? So what proof are we requiring? So when we have a roof that has no permit, but we have billing that shows that it was redone by the JJ roofing company 7 or 8 years ago, but without permit, does that screw us? What happens there?
The permit is the easier way. I can just show a permit and that's an easy approval. If you have an invoice from the contractor with the contractor's license showing that you paid it and they did it and it's all completed, that's good enough for us, because like you said, right, like not everyone's going to complete the inspection and everything, but if it's a new roof and we have an invoice, it's been done. It's just that Uncle Sam didn't, get their cut or didn't get paid up on everything else. So we can accept the invoices from the roofer that shows that it's completely replaced on a certain time.
Let me just stop for a moment here. This will also, practically speaking, be a difficult issue and more difficult for a flat roof. So there are a lot of homes in San Francisco that are boxes, right? 2 and 3 unit boxes, basically, and they have flat roofs. The problem that I think you should anticipate is Well, the roof itself was entirely replaced 22 years ago, but there was an overlayment done, or we've been doing maintenance every whatever. And so now the question is, how old is the roof? It's more difficult to determine how old a flat roof is than a typical shingled roof that has a slope. And I can imagine we run into problems with that. All right. What about foundation type, original heating? What about knob and tube again? And for knob and tube in particular, is there an inspection, right? How do we determine that we do or don't still have knob and tube, especially when we have remodels that often update some of the electric, but maybe not all of it?
Dan, real quick, can we,
Yeah.
before we move on from roof type, I have a question for Aaron and Alie. So I had a client who, like Dan said at the beginning, they were covered, we closed escrow, and then the insurance company flew a drone over and gave them 30 days to have a roof inspector. They said, we found $5,000 worth of work that needs to be done. We're not going to specify what that is. You need to have a roofing and contractor inspector come out and look at it. And then my client, unfortunately, just had someone come out and sent it on to the insurance, and it was $5,000 of different work. I was like, never said, but anyway, so I'm wondering, is it in addition to these like 3R reports and invoices, you said like for renewal purposes, you're just kind of like drones is now the norm. Is that correct?
So I love that. And by the way, the next slide does a lot of that and the cancellations, but we're there now. So let's talk about it. So let's talk about the insurance commitment, right? And so we'll rotate back and forth between these two slides. So we feel like we have an insurance commitment, but what is the underwriting process? When might it be withdrawn vis-a-vis just before close of escrow, 30, 60, 90 days after close of escrow? And then ultimately, we'll also talk about existing policies where there isn't a sale, there's just a renewal. What are we seeing for the renewal? So let's keep that conversation going. Aaron, please tell us what you know.
Yeah, so at Farmers, I'm the field underwriter, meaning I get to basically make the best judgment for farmers. Hey, this is good, it's eligible, so on and so forth, based on all the information I was able to gather. But they will get the final say when they send out an inspector to look at the home. Typically, if you know what you're looking at, you should know, hey, this is not a good enough roof. It's not going to get approved. I'm not even going to bother offering you something, because why put you in the position where, hey, when they came out 30 days later, they're telling you, hey, we're going to cancel you in 30 days unless you fix this. So if it's something like simple, like for example, you have an electrical box that is a Federal Pacific or a fuse, let's just say for example, it's not even a circuit breaker. Those you could probably even get replaced within one or 2 days. So those are quick fixes where somebody can turn that around and get reinstated right away. In terms of cancellation,
by the way, that assumes you can get an electrician out there quickly. That's quite the assumption, by the way, but keep going.
Yeah. And in terms of Nicole's question about cancellations without knowing what's wrong, I always, if I have a client that, is being canceled, I will always talk to the underwriters and get an idea. What exactly do you want them to fix? Because I'm not going to just tell them to fix everything. So we don't play these guessing games. I'll take the time to talk to the underwriters and figure out what's wrong before we tell Nicole, hey, this is what needs to be fixed. And once you get that done, then we're good to go.
What about this inspector? So I'm sure every agent just said, wait a minute, who's the inspector? Are they coming into the house? Are they calling the homeowner? Are they setting up an inspection? Could we push to get that inspection before close of escrow? Imagine if you're a buyer with an insurance commitment, and the agents are all thinking this, I'm sure. You're a buyer with an insurance commitment. You have not yet removed your contingencies. And by the way, we have a slide coming up that talks about the contingency. San Francisco purchase agreement was changed within the last year to have a separate insurance contingency. Just like all the others, the buyer has to satisfy themselves in their sole discretion that they can get the coverage they want at the price they want, or they can cancel the contract. The car form is going to be having that starting in June. We have given them our language and convinced them. So what the agents are thinking is, it would be much better if we could get this inspection before close of escrow and before we remove our contingency, because if then the insurance company says no, you have to do $26,000 worth of work, we have an opportunity to negotiate that with the seller. So what is the underwriting process? Who is this inspector? How do we bribe the inspector? I'm sorry, how do we satisfy the inspector? Please, more.
Inspection, Farmers hires a third party to go out there. So we don't know when they come out. It's usually within the first 4 weeks. They don't really tell us. For the most part, we used to, if it's not considered a high value home, not market value, but replacement cost, we typically will just usually look at the outside. But lately, we've actually been also doing the inside as well because of overexposure and, too much losses. So we're wanting to be more careful and picky with who we want on board as a client. So what you can do, we don't do pre-inspections because it does cost money, right? And, you do pre-inspection and they don't buy the policy, we end up having to eat the cost. But what you can do is I always ask, so I do my due diligence by every time I get a client that's referred to me, I always ask for a copy of the inspection report. The inspection report will tell me anything that's wrong with the house. And it'll tell me, there's certain things that, okay, you know what, you can fix that later. That's not going to be a huge deal for farmers. For this, okay, this is, a little bit of wood rot, you can just get that, refixed. But hey, this is a big issue. Like, hey, if the inspection report shows, hey, the roof looks like it's beat up, and I know you cannot get a roofer out in the rainy season, get within 30 days to replace your roof. I mean, even if it wasn't a rainy season, I think the waiting period is like 3 to 6 months just for a roofer. So in that situation, I would let the client know, hey, this is not going to fly. We're going to, you might end up needing something called a builder's risk, so that you can buy the house with a policy that's sufficient, and you're going to have to do all the fixes. And once you're done, then we'll get you traditional homeowner's policy.
That does not sound great. Alie, what are your thoughts here?
Yeah, similar to what Aaron was saying, we do a lot of the underwriting on the front end. We work hand in hand with underwriting just to make sure that they are meeting their requirements. The carriers aren't really interested in writing a policy and canceling it right away. So they're going to do more of the underwriting on the front end. Typically with our inspections, they are also 30 to 45 days after closing. By then, they're not going to point out anything that needs to be repaired. That's usually addressed on the front end. And then similarly with high value carriers are the ones that will do an internal inspection, whereas everyone else will do an exterior just to make sure the home is in one place, in one piece, and the replacement cost is reflected accurately.
So the high value is interesting because what they are telling us agents is it's not the value of the property, meaning did the market value sell for $3 or $4 or $5 million. It could be that the house is a piece of very easily replaced small thing on a fantastic lot. And so the whole property is worth $5 million, but it's a shack on a lot. And therefore its replacement cost is actually very small, as opposed to a new, beautiful build, glass and steel building that is on a tiny lot, right? And maybe the nicest home in the neighborhood. And therefore it did go for $5 million, but everything else in the neighborhood is going for a lot less. And so the land isn't worth that much. It's the structure. That's the high value that the insurance companies are interested in. Let's go to the next slide, Jeremy, which is all about canceling policies, right?
Should we go back to the knob or to the dip foundations and real quick?
Sure.
Because there's a lot of
questions.
That's a great idea. About that. Yeah. Knob and tube. Yeah.
Yeah.
Okay, so we haven't touched it. We haven't touched it all on foundation. We haven't touched about it all on plumbing, asbestos, or automatic shutoff valves. So what are our thoughts?
I wanted to just kind of add that, I think the question is, so what are we supposed to do if the home has these items? Like, what are our options? And I did want to add that we've been successful in placing properties if the buyer can obtain a signed work order or contract from a licensed roofer or electrician saying that immediately after closing, we have it scheduled to have it worked on. And that has been a way, like a ticket to be able to place it with a carrier, knowing that there is knob and tube there.
Aaron, does Farmers accept that at all?
No. Yeah, if you have these items that make it ineligible, we're just going to tell you, hey, get a builder's risk and work on it. And once you get everything, completed, that's updated, electrical, roofing, plumbing, and all that good stuff, heating, then we'll take you on as a client for a traditional policy. For clients,
and so a builder's risk has very limited liability, and I assume that it covers, for instance, fire, but not a lot more?
Yeah, so builder's risk will typically cover the structure as well too. The structure for fire, water damage. You can get a policy that includes liability as well too, and with the acknowledgement that they know that it's going to be under renovation. So you're not really tippy-toeing or lying to the carrier. They know exactly what exposure they're facing, which is why the premiums for these builder's risks are not cheap.
There we go. That was the next question I'm sure everybody had. All right, so it's more expensive. Okay. What about foundation types? Still haven't talked about that. So we have a brick foundation, we have, a half brick, a capped foundation, etc.
Foundation type for us at least doesn't really play a big difference unless they want to purchase earthquake coverage.
Okay.
So for earthquake coverage, foundation will play a role. It will likely just be more expensive.
Jeremy?
Same here.
All right, great. I want to tell an amusing anecdote real fast. When I was an agent, I was representing a buyer, and for whatever reason, the listing agent was following us around the inspection, super annoying. And we got to the brick foundation, and she said, quote, well, yes, it's brick, but it went through both earthquakes, meaning the 1906 and the 1989 earthquake, and the house is still here. And the inspector said, and I loved him for it, and this was John Kerrigan. For those of you who remember John, unfortunately, he's died. He was a lovely man. John said, yeah, and I don't think that made it any stronger. Loved that. Thank you, John Kerrigan.
One thing I want to touch base on is the plumbing. So fire, as you know, in California, fires definitely our biggest factor in losing money for carriers. But the second biggest factor in claims and losses is water losses, not weather related. So,
Right.
for example, a pipe burst, garbage disposal malfunction, dishwasher malfunction, that sort of stuff. So what Farmers is doing now is we're mandating that any homes that are 30 years or older have a water leak detection kit with an automatic shutoff valve. But you have 45 days to complete that task after we issue your policy. So it's a pretty simple thing to do. There's a couple, companies that you can get it from, and you get a plumber to install within, 2-3 hours. And then what happens is when there's a water loss and it detects it and it's abnormal water loss, it'll automatically shut off the water valve. So this way you're not creating a giant loss. And that's helping prevent from, larger and larger claims so that the company can be a little bit more profitable and, and be able to, kind of have, we're trying to come back. We want to insure people, but we need to stop the bleeding first is what we need to do. And water loss is the number 2 losses we have.
Okay, so that's interesting. And I was thinking to myself, I didn't realize that. And yet somehow I wrote that already here on the slide. So apparently at one point I did know about that. That is very interesting. And that is something that I presume that you could actually market a listing to say, hey, we do have a newer roof. We do have an automatic plumbing shutoff valve. We have replaced the knob and tube wiring. We have all of that documented for your buyer, not only for their own peace of mind, but for their insurance agent, right? There we go. Okay, so we talked about the insurance commitment. We're on to canceling policies. So what about our current homeowners who are calling us and saying, remember that house that you put me in 2 years ago? Well, the reason I know it was 2 years exactly is because my anniversary date of my insurance policy is coming up, and I got an FU letter of sorts from my insurance company telling me they're canceling or telling me they're sending out an inspector, right? So our renewals, I think what we're hearing is that our renewal policies, our renewal requirements are looking very much like the new policy requirements, requiring some sort of underwriting, sending out a drone, looking at the roof and asking questions about knob and tube, etc. Is that correct?
Farmers is doing re-inspection, and so we are using technology like drones and satellite views and everything like that. However, we definitely have a lot more leeway for existing clients that's been with us. We're not just gonna kick them to the curb after so many years of being a great client of ours. So what we do is if we do notice something wrong with it, we will give them until their upcoming term renewal to basically get these fixed. Usually they give you at least 90 days to get these things repaired or fixed.
So let's just stop there for a minute. So more than 90 days before the renewal, you're doing what at Farmers? Tell us the secret sauce.
Yeah,
You
we're,
said,
we're using satellite view to look at, Google Maps, satellite view. We're looking at the top, trying to make sure there's not like a bunch of debris all over the place. We want to make sure that there's some type of pride in ownership. We want to make sure that the roof doesn't look like it's just looks, you can tell what's a good roof and what's a bad roof too. Some of the times though, we'll run into things that are old satellite photos. And I've actually seen that before where we say, hey, that's an old photo. Like client literally just got his, roof, replaced last year. And that photo is probably from 2-3 years ago. So in that situation, we just provide them with an invoice and they say, okay, you know what? No problem. We'll lift the non-renewal. No issues with that.
let me give an inside baseball tip to the agents. Write this down. Fortress Fire. Fortress Fire is a company that has partnered with CAR, and from your local JCP or whatever your title company is, you can get an add-on to the report for $140. Fortress Fire does an overview satellite photo that shows the structures on the property lines, where all the trees are, and what if there's debris, and gives you an estimated cost for your client to be in compliance with defensible space laws if they want to be. Defensible space is not a point of sale requirement, and for properties inside San Francisco, we're not having the AB 38 problems with defensible space. But this would actually be an interesting gift to a client who's sitting in a property to say, hey, by the way, your insurance company is going to do something similar, and they're also going to evaluate your roof. And here's what this Fortress Fire says. And you may anticipate the insurance company saying to you, hey, you need to do some of this work. All right, I'll throw that out there. Alie, what have we missed?
So one thing on the broker side, at least, we have an account manager, account executive team that has a book of business, and they actually reevaluate renewals in addition to the renewals on the carrier side. So if there was a concern, we take it upon ourselves to remarket the home if it is going to be canceled at renewal. But similarly to the carriers having to submit to the Department of Insurance rate increases, they also can submit underwriting guideline changes. So at that point is when they can, decide that a certain zip code they're going to non-renew. Again, we're given enough notice to where we can take the burden off of our clients to be able to find them another option.
Well, speaking of increases, so how often are we seeing, and because there's regulatory requirement to allow for an increase, how often are we seeing insurance companies who internally are saying, yeah, it's time for renewal, we're willing to renew, but only if we double or triple the premium, and maybe the state won't let you do that, and so then you just say, all right, well, our new guidelines are X, and we'll just stop writing these policies. Are we seeing that balance that's hurting us, where the options are one of two: increase to an extent that the government won't allow, the insurance commissioner won't allow, or cancel the policy? Alie first.
I mean, that's kind of what we saw with State Farm last year, right? They submitted a rate increase, it got denied, and so then they had to pause new business. Unfortunately, the Department of Insurance has to work harder to streamline the process to grant these approvals to be able to keep the carriers in a financial position to continue to write policies. So, it's a trending industry. State Farm did receive their approval for a rate increase this year. So we are expecting to see other carriers across the board obtain, their rate increases and then open up again.
And so, Aaron, how substantial are these rate increases? So I've had a policy with your company for a long time. Will I see a doubling?
Yeah, you could potentially. So they have remapped all the risk again because they used to be really general. So now they're being more specific in terms of, honing down on the specific area. So one of the things one of the misleading articles I just recently read on SF Chronicle was saying that Farmers is non-renewing all homes that are 1925 or older. What they were referring to is all the commercial lines real estate. So if it's a commercial building that's older than 1925, we're not renewing those. For the primary residence personal line side, you're a 1 to 4 units, we're not doing that. We're still grandfathering everyone in. I haven't experienced any You know, the rate increases are based on what Department of Insurance grants us. We can't just, you know, willy-nilly just increase people's rates, triple the price. However, if there are factors of their home, for example, when we re-rated one of my clients' houses, initially when we rated it, generally it was like a fire line score 2, and then after they re-rated it and they remapped the risk, they said, hey, you're at a fire line 6. We technically we shouldn't have even taken you at all. And so they said, you know what, but because you've been a client, we're going to grandfather you, but we're going to double or triple your price, because now we're rating based on the correct factors. It's not that we're raising the rates for dollar for insurance. We're raising it based on the correct factors now.
Or the change in what the factors are most important to you. It's interesting. All right. Nicole is reminding me we have lots of questions. So let's go on to the California FAIR Plan, and then we'll take questions. And I think we can totally go over in time.
Yeah, we have 15-minute extension. So just so everyone knows, this is recorded, but we will be answering we will get to all the questions as well.
Okay, great. So next slide is the California FAIR Plan, also often known as the Plan of Last Resort. Interestingly, this is not the updated slide. It's interesting. I wonder why that didn't update. The California FAIR Plan, you see the $1 million cap, question mark, question mark, question mark, that is now $3 million. The California FAIR Plan also increased commercial coverage to $20 million. I think it was 5 before. And why does that matter? HOAs are thought of as commercial. Okay, so the California FAIR Plan is strangely quasi-governmental, in the same way that Fannie Mae and Freddie Mac are strangely quasi-governmental. There's an odd overlap here. I would think that of our 2 experts here, it's Alie who's going to have more to say about the California FAIR Plan. I have a feeling that, Aaron, you tell me if it's right, when you're unable to quote a policy and the client says to you, what do I do? One of the things you may say to them is you may be eligible for the California FAIR Plan. And then they say, great, can you help me with that? Is the answer no, I can't?
No, the answer is typically not no for me. I would typically try to even look at the non-admitted market before I go to California FAIR Plan. So
like Lloyd's of London and others?
Yeah, I would suggest always looking at other options, you know, before, you know, because maybe farmers will take the non-fire portion, meaning the water damage, hail, you know, winds, you know, but, you know, then the California FAIR Plan will take the rest of the fire stuff. However, even if that's the case, I typically will, you know, I'll usually advise them that, hey, you might want to see other options. I have non-admitted markets I might be able to place you to that will have a full package rather than having to, you know, chop everything, you know, together.
Okay, and one of the reasons you said that is, and Alie was nodding her head in agreement, I think it's because the California FAIR Plan is expensive, and there's a reason we call it a last resort. Plus, it doesn't include personal property or liability, and so we still would need separate policies or riders. Alie, talk us through it.
Yeah, so same with Aaron, we try to exhaust all options before going to California FAIR Plan. It truly says it on their website. It's the carrier of last resort. You're basically stuck with purchasing 2 policies. The FAIR Plan covers fire and smoke damage only. The difference in conditions policy covers all other perils. Combined, yes, you have what's considered full coverage, but you have 2 different companies that you're working with. I compare it similar to the DMV of insurance. There's no advocacy. It's sort of just take a number and wait your turn. And we see these properties being placed with them, and they really are underinsured because they don't have the ability to write for the full replacement value.
All right, appreciate that very much. All right, let's skip forward 4 slides. We're going to do one more on the insurance premiums. How are they structured? Slide. Keep going. There we go. So one last thing I think I'd love the experts to explain to us is the premium itself, right? So liability coverage is almost always included. Personal property, often 50 to 70% of the dwelling coverage. But figuring out the dwelling coverage is really interesting to me, right? So how do they decide we need $1.2 million or $3.2 million for replacement cost? And then we have these extended replacement costs. Sometimes they give you a replacement cost of $3 million, but they say, don't worry, you get 150% of that. Well, why didn't you just quote me $4.5 million? That seems weird. And then when you want to add on to the replacement cost, it's like your car insurance. It's pretty cheap to add on. It's the initial coverage that's usually most expensive. Then we have some dwelling extension context for detached structures, and we have some loss of use coverage for a stay in a hotel, etc. Do either of you want to help us understand how the premiums are structured before we go on to the questions?
I can chime in. So basically, when they go into rate, a lot of it is a percentage of the overall dwelling. How the overall dwelling is configured is, at least we use a replacement cost estimator tool, and that factors in all of the details of the property, and it takes into consideration what has been paid out in similar areas. Inspections also play a huge role into what the dwelling coverage should be, and then rate is determined from there.
Okay. And what is your experience with whether or not that actual, the tool that you use comes out with a number that's realistic, right? Can we actually get the house replaced by an actual contractor who really does work in this area for that amount? And by the way, I throw this out there to you. One of the reasons these numbers are often way too low is because when there is, in fact, a need to replace, sometimes it's not because just one home suffered, right? So if it's part of an earthquake or a big fire, now we have the market saying to us, wait a minute, demand versus supply. We only have so many contractors. I'm no longer willing to rebuild your house for $3 million. It's going to cost you $4.5 million. Aaron, some of your thoughts on this?
Yeah, so that's what your extended replacement cost is typically for. First of all, you want to make sure your house is fully covered, for the proper amount. And then once you get that down, then if, let's just say, there is a demand, supply and demand issue, and contractors are charging more, that's what your extended replacement cost is paying for. You don't want to use part of your extended replacement cost as your primary coverage. You want to use that as your buffer. One of the things that I noticed lenders all, they'll look at for when we offer them the evidence of insurance, they'll ask for evidence of insurance and a copy of the replacement cost. Typically, if the agent is doing it as accurate as possible, they'll usually accept that, or they'll want to make sure that we at least meet whatever the appraiser's opinion is to rebuild the home. So on, I think, page 5 of the appraisal, you'll see the opinion of the reconstruction cost from the appraiser, because they went in there, measured everything, they know the specific areas and more or less, the cost to rebuild.
Appreciate that. Thank you very much. All right, are we ready for questions? Oh boy.
Yeah.
All right, Nicole, take it away.
Okay, so first, Stephen asks, is there a directory of insurance agents and brokers?
That's interesting. So they're licensed. I bet the Department of the Department of Insurance has a list somewhere on their websites. Do you guys know?
They do.
Yep.
They have a list of.
Licensed agent is listed. Yeah.
Yeah. Thank you. Okay, and the next one. So Sandra asked, how is insurance looking at properties that have upgraded electrical panels and some renovations to wiring, but still some old knob and tube?
So we have a mix of upgraded because they did a kitchen and bath remodel, but not the whole house.
They're going to want it all updated.
They want it all. It's all or nothing.
No. And how do they, are they opening up walls? Because sometimes it's covered.
They're not opening up walls, but if it is disclosed, they will want it all to be removed. I do have one carrier that will do 15 to 20% knob and tube as long as it's just remnants. So meaning if it's in the attic or basement, if it's not active in the kitchen or bathrooms, then they're willing to accommodate, but at least by renewal, they would like that cleared out.
Great.
So when you say if it's disclosed, they may be asking for a home inspection report,
Correct.
for instance?
And they're not opening up walls, but if you told me, hey, there's no knob and tube, and we put that on the application because that's what you told me, you are signing the application saying that you are giving us, all the true information. And if a claim arises from the knob and tube wiring a fire, they could deny the claim. They could say, okay, well, I'm not paying for this. You lied to us.
So that's super frustrating. So let me ask you this question, Aaron. Here's what sellers are used to. The questions that the seller has in the disclosures are you seller aware, right? And so it's not a guarantee that it's true. It's just based on their awareness. If I'm a buyer, I'm even less aware than the seller. And so am I making a guarantee when I say there's no knob and tube? Or when I'm filling out the application, I'm relying on what I've been told in an inspection report and by the seller? And if they both told me there was no knob and tube, can I write that in there, or am I going to get hit with that later?
Your home inspection will tell you what type of wiring you have if you do a home inspection.
Not everywhere. I mean, a lot, they definitely conceal this kind of stuff inside the walls. The inspector is not opening walls either. All right, that scares me. Next question.
Yeah, no, fair. So, and this is kind of goes back to, I think the HOA policies versus the in-unit. So if there's knob and tube in the basement of a condo building, but not in the unit, will agencies grant insurance?
They'll grant HO6 insurance, so walls and insurance.
Yeah.
But not necessarily the master policy that actually covers the loss.
Correct.
Yeah, HO6 is not, we're not looking at the wiring.
Okay, so imagine this, by the way, that's even worse. So if you're a seller and you're in a 2 or 3 unit HOA, right, you're gonna hate your neighbors when you're trying to sell and we have partial knob and tube and you can't get them to cooperate to put out the money to replace it because they're not interested in selling and they don't really care that it's gonna totally undermine your sale. Super frustrating. Or just as bad, you're in a 50 unit HOA that was built in the 60s, right? And they have knob and tube, right? And now we need to get the entire HOA to talk about, you know, issuing, God, what's the word? I can't even think of the word, assessments, right? To fix this. Good luck trying to get that done in any particular time frame to sell your house. Very frustrating.
On that note, Dan, so what
Yeah.
happens with the HO6 coverage if you do have a neighbor, let's say downstairs, whose unit does have knob and tube that's active and that causes a fire that extends to the unit that is being covered? Does that affect the coverage at all if it's another neighbor or if it's in common area space?
So with another neighbor, if it's the neighbor's fault, then their liability would then cover the other unit.
But what is fault, right? So if the fault is a latent defect because of knob and tube wiring, I think the answer is going to be the master policy will not be paying to repair the structure. And so you and your neighbors may all have to figure out whether or not this is coming out of reserves, which it probably is, right? The HOA is still responsible for the structures, right? So it may just be coming out of reserves and there is no insurance for it, but your HO6 policy will at least pay for your contents and for you to live somewhere during the construction. Am I right, people?
They'll
Right.
cover that.
Okay. Next question.
And just everyone's asking for the speaker's contact information. We will send that out along with, sounds like a lot of people want the slides and there will be a recording. So we'll just send that all out after. So everybody has
If
it.
somebody wants to type the
Slides,
question in the
yeah.
Q&A, I'll go ahead and put the
I did respond to Tom's with both Alie and Aaron's
Great.
contact info as well.
Okay.
If you want to look
There's
at
a fee for the slides. I put these together. It's $1.99. Just Venmo me.
That's it? Oh,
But no
okay.
Bitcoin.
Okay, we answered that already. So Cynthia asked, we've been putting silicone membranes on our existing roofs. They are durable, waterproof, flexible, UV stable, and remedy proof. Problems that normally be fixed without a complete replacement. In theory, they are superior to virtually every other flat roof system. They don't need a permit. How would insurance companies react? And send to info. That might be a one-off question unless.
It's interesting.
Farmers is still looking, they want it, like, if they want it, they're looking at replace date, not updated date. For other items like commercial risk or other carriers that I can have access to, they don't mind just looking at the updated thing. It doesn't have to be fully replaced. So it really depends on carrier specific.
Okay. And then, how many inspectors still do drive-bys and do they specialize in roofs, electrical, etc.?
For the insurance inspectors?
So I think the question, let's broaden that question a little bit. I think the question goes back to before they bind a policy, how many of them are doing a drive-by rather than the more extensive and expensive inspection? Because we had heard Aaron say earlier that that's sort of expensive, and they typically do that within 4 weeks of the close of escrow. So Alie, how many of them are doing a drive-by cheaper before they bind the policy before close of escrow?
So for our mid-market carriers, so replacement cost of 1.5 million and below, they'll do a drive-by, but it is still done after closing.
Okay, so we still have that problem. You think that everything went well, but after close of escrow, you may find something else. Very frustrating because, again, we have this insurance contingency, right? And we think we're in the clear because we have a policy, but the client turns out to have expenses after close of escrow, and they may or may not have the money. In fact, right after close of escrow, for first-time buyers in particular, they may have very little money left. So this is really, I can imagine you as an agent are in a really difficult position here with your clients with older homes in particular.
Yeah, if you can get the inspection report to the agent so that they can preview it and do the field underwriting, typically they'll know if this is going to be insurable or not by the carriers they're working for.
Yeah, that is a great tip, right? So before you remove your insurance contingency, send the inspection report to the carrier, ask them to have one of their people like Aaron look at it and give you an idea of whether or not only can they bind, but will they continue with this policy after close of escrow?
I had one like in November where we were good to go 2 days before close of escrow. November 1st came and the insurance provider changed their policies. And so even though we were good to go up until that date, 2 days before close of escrow, we were SOL. And so my clients ended up getting, which is kind of the next question. I assume a builder's risk coverage is similar. They got a construction policy, and they removed the knob and tube. They updated the heating. They took out all the old ducting system. So is that kind of the same as builder's risk? And someone asked, would builder's risk coverage satisfy a lender?
In my experience, course of construction or builder's risk, unless you're getting a builder's loan, then it will satisfy a lender. But if you're getting a loan for just a standard home purchase, typically not. They won't accept it.
Okay, so that's really important. So what we just heard was we do have an option of the builder's policy, right, where we can't otherwise insure. But if that option is happening before close of escrow, that's not going to satisfy the lender. If, however, we have one of these situations where we're given a whole list of items after close of escrow and said, hey, you have to change it within 30 days and it's just not practical, they could in theory switch to a builder's policy then. Now, would your lender be notified? Yes, they would be, right? Would they call the loan? I have a feeling they would not call the loan, particularly if you have, some contractor says, I'm going to do this. But not giving you the loan in the first place is different from calling the loan after close of escrow.
My clients got it. So Lloyd's of London was the only, we talked to 25 insurance brokers in the 48 hours, and Lloyd's of London and the lender involved were able to agree that that was a construction policy is how we closed. And now they updated all that, and then they're going to cancel that after 6 months and then get it. Is that not the typical?
So you're saying that Lloyd's of London, who's a non-admitted carrier,
So that's why, yeah.
They gave the policy or they gave a construction?
They gave a construction policy.
And
Yeah.
that satisfied your lender?
Yeah.
Interesting. The last time we used Lloyd's of London, so they arrived in a Rolls Royce, the inspector did, and he presented us all with Grey Poupon. And I said, but of course. I'm sorry, Aaron, you were about to say something.
I've seen lenders, lend out on traditional homes that just need some updates. Like for example, hey, the roof needs to be replaced. And, I explained to the lender, hey, until it gets replaced, we can give them, a builder's risk. However, if it appraises or not, that's a different story, right? So for example, if let's just say it doesn't appraise for what we're insuring it for, then that, the lender might not lend based on that factor. But for the most part, I've had success with, people getting a primary residence policy and I'm sorry, people getting a primary residence loan, but then they end up getting a builder's risk. I've had success with that before.
By the way, Jeremy made a good joke. Also, I would say this, it's not easy being a real estate agent. So I started in this business about 30 years ago, defending real estate brokers when they got sued. It was so much easier then. There is so much stuff that you people have to know. And if you're thinking to yourself, my God, do we earn our whatever percent? The answer is, you sure do.
And now that's being questioned as well.
Yeah, I know it is. That's the thing. And I want to say, you sure do. All right. Do we have any more questions? I know we're
yes, we have a lot. So I'm just going to kind of go through these really quickly. So what circumstances by which earthquake insurance is actually usable, etc.? Home shakes and pipes and wires are dislodged, causing fire, then water damage. Does earthquake insurance cover that? Or would a regular building insurance plan cover that?
So water damage and fire following an earthquake is covered by a regular homeowner's policy, but earth movement, or if the building were to collapse, that would be covered under earthquake.
Perfect.
And not covered under your regular policy. So the
Correct.
joke is, you better pray for a fire right after the earthquake, right? And this is one reason that insurance companies want an automatic shutoff valve for the gas line, right? Because when the earthquake rips the house down and the gas is going everywhere, and you happen to be a smoker and you flick your cigarette, the good news is you have coverage. But
what are the costs of those installation and kits? Like 1,100-1,200, I've heard.
I think the automatic gas shutoff valve is probably like $1,000, give or take, including installation. The water leak detection kit, I want to say between 1,000 and 1,500.
Thank you.
Let me say one other thing regarding water intrusion. So we don't have a lot of flood policies here, right? But let me just tell you the difference between what's covered and not covered. If it's raining like crazy out and the water comes from the ground up, that requires flood insurance, right? And if you don't have it, you have no coverage. If it's raining like crazy outside and a tree falls, makes a hole in your roof, and all the rain comes in through the roof or through the terrible flashing that it turns out the property had, right? That's covered under your regular policy without a separate flood policy. Okay.
Thank you. Yeah. Okay. Does it help to get the 4-point inspection sign off from the inspectors when you get the property inspected for pre-market?
I think it helps with our carriers 100%. Any documentation, supporting documentation that's going to, make it more enticing for the carriers to offer coverage is going to go a long way.
Thank you.
Great. One thing of coverage that you need to remember to do for your clients is, does your client have the right coverage for a house that they bought, then moved out of, and are now renting? What you want is you want a landlord policy with coverage against wrongful eviction, particularly here in San Francisco. We heard Aaron say earlier that his company is less likely to write on those than they ever have been, but you want that. And so one place you can add value for your client is a client who is left the house and is now renting it out, or when you take a listing and there's a tenant in the house, ask your client immediately, what coverage do you have? It's possible that they bought this house, it was their own home, so they didn't have this coverage. They moved out, they never got this coverage. And now that you're putting it on the market and going to piss off these tenants, they may sue. And so you want to encourage your client immediately when you sign a listing to say, call your insurance agent and make sure that you have the right coverage. Even if you add it now and we sell now, you want that coverage in case something happens with these tenants. Okay.
Yeah, that's why it's a good idea to touch base with your agents. I always send out an email renewal offer from my staff, and it always says, hey, let's touch base, make sure everything's up to date in case you have new drivers in the household, in case you updated your home and added solar panels or added bathroom. We want to make sure that you're properly insured and you have the right product for what you need it for.
What about Taylor Swift? So Taylor Swift and bundling of policies, that seems to be important these days. Have either of you met Taylor Swift, and have you ever bundled a policy with, who is that? Is that Geico? Who is that?
State Farm.
That's State Farm.
Kelsey and State Farm and Mahomes.
Okay. What about Geico and the Caveman? Have you met the Caveman? Do they do any policies here in California?
So one thing I have to be aware with Geico homeowners insurance policies that I can give you guys a fair warning on is the agents that are writing these homeowners policies are not from California. I want to say 99% of them that they send me, you know, the client would send me the quote, and I'm like, that's way too underinsured, and they're having a hard time fighting with Geico trying to get higher coverages because they're like, why would you need $300,000 to rebuild your house? I could build a mansion here in Arizona. Well, you're not in Arizona. We're in California, San Francisco Bay Area specifically. So one of the trouble points my clients are having is getting proper coverage because those guys are not from here.
That is very good. All right.
To add to that real quick too, we see that with self-service like Lemonade, you know, Hippo, when you're going in and the client's entering what they think their home needs to be, you know, insured for. We do run into some gaps in coverage because they don't have an advisor to point that out.
Appreciate that. All right. I know that is not the most exciting way to end. Probably the most exciting way to end is to hear more from Jeremy about the cuckoo clock behind him, or Nicole and her grandparents' collection of cuckoo clocks. But believe it or not, we don't have time for that. What we do have time to do is to thank each of our guests. And so, Alie and Aaron, thank you so much. I think that we all learned. Nicole and Jeremy are putting together great programs for you through our Education and Events Committee. And we want to thank our young professional network for all of your work as well. I'm sorry, Jeremy.
Dan from SFAR, everyone at SFAR, yeah. And Dan, yes. Of course, thank you, Dan, for your time as always. And then there are some questions left. Aaron and Alie, are you okay if we direct them to reach out to you on their own? Okay, great.
Absolutely.
So much, everyone.
And thank you to the 161 people who showed up. That's an amazing attendance. So thank you so much.
Shows that we have some, we've all been experiencing problems. So this is super helpful. Yeah.
Yeah, super fun. Okay, we are declaring it a success. Everybody, thank you very much. We will see you at another informative program soon. Goodbye, everyone.
Thank you.
Thanks, everyone.